I don't think you can understand the recent past, including the crisis, without understanding what I call Chimerica. And it's a pun, of course, because it's about China plus America. And the question is it a chimera? So a pun that I hope you'll forgive.
Yeah.
The idea is that although China plus America is a relatively small percentage of the world's land surface and about a quarter of its population, it's roughly a third and growing of the world economy. And it was responsible for about 2/3 of economic growth in the past 6 or so years. And I came to see that if you could understand that relationship, most of what was going on in the realm of globalization would make sense. Now, it's an extraordinarily complex symbiotic relationship that has evolved since the 1970s, and particularly in the last 10 years. The most important components of which are as follows. One, Chinese labor costs and the low price of Chinese products has dampened down inflation worldwide, and particularly in the United States. That's been an important factor in the profitability of corporations. Two, China relies heavily on exports to the US and elsewhere, and therefore worries that its currency must stay relatively weak, otherwise those exports may no longer be as attractive. And therefore, three, China intervenes systematically in foreign currency markets in order to keep its currency relatively stable and weak against the dollar. This intervention has involved the accumulation of more than $1 trillion worth of dollar-denominated securities, including, interestingly, the bonds of Fannie Mae and Freddie Mac, but also a whole bunch of US government treasuries. And that accumulation of government debt has had the effect of keeping American interest rates lower than they would otherwise have been. In other words, to put it really simply, for reasons of their own, out of self-interest, the Chinese and, of course, other Asian and Middle Eastern economies have financed the US current account deficit, have financed American borrowing. And when the current account deficit gets up north of 6% of gross domestic product, in an economy as big as that of the United States, you're talking about a really large amount of borrowing that can be financed from abroad. And the reality is that that's what underpinned the great bubble of the early 2000s. The real estate bubble was only really possible because there was a wall, a glut, in Ben Bernanke's phrase, of Asian savings available to finance US consumption and US real estate speculation. It's an extraordinarily complex story, but it does reduce to something as simple as this: a marriage. China plus America, Chimerica. And like in a lot of marriages, one partner was a saver and the other spouse was a spender. America was the spendthrift, I won't say wife for want of being accused, for fear of being accused of sexism, but let's say the spendthrift partner. And China was the frugal saver. It seemed like a marriage made in heaven, and it certainly propelled the world economy through 4 or 5 years of extraordinary growth. The trouble was that the spendthrift partner blew the money on real estate speculation and high street shopping mall consumption. And when the deal went wrong, when the bills fell due and the property prices fell, it seemed as if Chimerica was going to be shattered. And I've spent a lot of the time since finishing the book wondering if this crisis really portends the end of Chimerica. Is it going to turn out to be a chimera, an illusory fantasy relationship? Or will it withstand this shock? That's a hugely important question, because if it does fall apart, if the Chinese say, you know, we're not going to finance America's borrowing anymore, then we will enter a much more dangerous world. Bad though the crisis seems now, it could get a lot worse if we don't get that Asian savings glut flowing into our pockets. One of the perverse consequences of this crisis has been to reveal that for investors all around the world, including Americans, the United States paradoxically remains a safe haven. So that when financial crises break out, the default setting is to rush into US government bonds and indeed into dollars, into cash. So what we saw as the crisis intensified in the last few months of 2008, as summer turned to fall and everything started to fall, it was the dollar that fell least. In fact, the dollar strengthened on world markets. And although the US stock market took a tremendous hit, other stock markets fell even further, including Brazil's, Russia's, India's, China's. These were the BRIC economies that we were supposed to believe were going to overtake the United States at some point in the decades ahead. Well, the bricks are dropping like bricks as we speak. And a lot of people are taking the view that although this crisis somehow had its epicenter in the United States, originated in the United States, nevertheless, the correct response to the crisis is, in fact, to increase your exposure to the United States. Life is so unfair. It's so unfair on the rest of the world. But it seems to me that paradoxically, this actually gives the United States a better chance of riding out the crisis than say, some European countries have. Because it means that if the United States has to borrow $1 trillion to bail out its banking system, that's the $700 billion plus the $300 billion that's already been committed, funnily enough, the rest of the world seems ready to lend that money at a reasonable rate of interest. That's the Chimerican deal, alive and well. Now, as long as the rest of the world continues to take that view, that it doesn't mind piling up great mountains of American government debt, then the US somehow walks away from this pile-up relatively unscathed, scratched, suffering a recession, but not going through the Great Depression again, not even going through the 1970s again. If, however, foreigners suddenly take the view that enough is enough and that the profligacy of Uncle Sam will no longer be tolerated, then we will see something very ugly, which is a dollar rout, higher interest rates, at the long end. That's to say, you'll suddenly see your 10-year Treasury yields zooming up towards 5 or even 6%. And then we will discover the real meaning of financial crisis. Let's hope it doesn't happen. Well, it seems bizarre because we used to think that economic development involved rich countries lending to poor countries. And that kind of was the model right up from the age of empire through to the 1990s, through really until the 97-98 Asian crisis. And then there was a kind of paradigm shift in globalization when the Asian economies in particular said, borrowing from these guys is too risky. The money suddenly gets pulled out if George Soros doesn't like what we're doing and we get whacked. So let's not play that game anymore. Instead, let's finance our growth out of our own savings. Let's aim to grow through exports. Let's buy dollars in order to keep our currencies weak. And let's let exports do the work. Now, the Chimerican deal was a pretty good one for the Chinese. Yes, they were lending money to the United States and not getting paid terribly much interest on the loans. But they were also getting an American consumer who seemed to have a limitless appetite for Chinese manufacturers. And as long as exports were growing, Chinese employment was growing, and the great transition from the countryside to the towns could carry on. So it seemed like a rather a convenient kind of marriage. Except, I think, that fatally, so much was channeled not just into buying Chinese manufacturers, but also into speculating in property. And that turned out to be the fatal turn. I think if just some of the money that Americans borrowed from abroad in the last decade had gone into investment in infrastructure, productive investment, perhaps also in improving education, it wouldn't have seemed quite so crazy. But the fact that it went into speculation in the prices of houses in states like California, that I think will turn out to have been a pretty major mistake.